Good morning, everybody. My name is Simon Nicholas. I'm a partner here at KPMG Isle of Man, and welcome back to week 4 of preparing for the new reality. It's great to have you with us this morning, and I'm joined in the room with Ed Horton and Kristen King, and we'll be engaging with those with you guys with conversation as we go through the webinar today. The usual housekeeping: if you have any problems with the connection, please just click the reconnect button at the top, and it will refresh you back into the room. Any questions, please feel free to put them into the chat box on the right-hand side, or email them to webinars@kpmg.co.em, and we'll take those questions as we go through. So wow, a lot can happen a week. This week has certainly proved that. The island is day 49 without a case from COVID, and we seem to be back into flight mode or holiday mode, with the Guernsey Air Bridge selling out within 3 days. Outside the air bridge, the Isle of Man government has announced their 5-step roadmap to open the borders, which is ultimately heavily dependent on the UK, as you'll all appreciate, who in turn are gradually starting to open up their hospitality industry. And I think we've all seen the pictures of the pubs and restaurants last weekend. But equally, we've already got Leicester back into lockdown. Later today, we'll see the Chancellor in the UK, where Rishi will be setting out his stimulus statement, with all eyes on the measures that the UK are planning on introduce to bolster the economy. And of course, closer to home, Treasury Minister Andrew Buchanan said on Monday at the Tynwald ceremony that the island won't know the full impact of COVID-19 until the autumn, as we await his budget update expected later this month. And then across the Atlantic, we've got election shots being shot in pretty much every direction. Unemployment, saying 1 in 5 Americans are unemployed, yet we still have the NASDAQ at an all-time high. As I say, a lot can happen in a week. But on to this week. Just walk you through the agenda. So continuing with the theme last week around investments, this week is more of a focus on capital markets and capital raising and potentially repairing balance sheets. I'm really pleased that we have 2 guests with us. Andrew Buchanan, who's a partner at Peel Hunt, a specialist investment bank in London, who knows the Isle of Man well and will be providing an overview of the capital markets and what's currently being seen. And then secondly, Ash Dougal, Group Director of Fundamentum Property Group, who probably are less well known, but recently listed on the International Stock Exchange, well, pre-COVID, I'd probably note, and launched a REIT. And he'll be providing an overview of sort of his stories and the emotional roller coaster of a listing process from his perspective. But I think I'll start with handing over to Ed and Andrew from Peel Hunt, who'll talk us through the capital markets and where they're at today.
Thanks, Simon. Good morning. I'm Ed Horton from KPMG, and I work in conjunction with our advisory teams on capital market transactions as reporting accountants across AIM and the main market. I'm joined this morning by Andrew Buchanan from investment bank Peel Hunt to discuss the UK capital markets. Welcome, and thank you for your time this morning. Andrew will provide a brief status check of where we are now before we explore further what lies ahead as we move from resilience and recovery into the new reality. Andrew, over to you.
Thanks very much, and hello everybody. So I'm Andrew Buchanan. I'm one of the partners at Peel Hunt. I'm also head of the financial institutions team in our corporate and investment banking division. But I'm here today to talk about the impact that the pandemic has had on the UK listed corporate scene. What are the key themes that are affecting corporates, how they're responding, how shareholders and other investors are responding, and what we can see looking forward, how some of these themes might play out and how they might be relevant to you from your perspective. So I think if you've got the slides that I'll be talking through in front of you, I'll just kick off with the key themes page, which runs through some of the main areas that we see as factors influencing the UK corporate scene. First and foremost, though, and it almost goes without saying that the pandemic is having very far-reaching effects and impact on the UK corporate landscape. Most evidently, that's coming through in the macro stresses in terms of the loss of consumer activity and other industrial activity through the lockdowns, social distancing, and the policy response that has taken place to try and mitigate those effects. Obviously, we're in the process of trying to unlock at the moment, and it remains to be seen how successful that will be as regards second waves and the recovery. But I think it's fair to say that we can confidently predict that, sadly, unemployment and SME failure will be some significant effects of the pandemic as the government withdraws a lot of its support measures. That's staff furloughing and some of the other SME support measures that's been put in place. Obviously, also the sectors that are most reliant on discretionary consumer spending, particularly in travel and leisure and other parts of the economy, will face the worst pain. And we mustn't forget that there are other macro factors that are going to come to the fore as well, some of which were very significant before we headed into this crisis, and some of which we've largely forgotten about in the main. Obviously, Brexit, which dominated the debate for 3 or 4 years, is now coming back onto the political scene again as the talks with the EU and the UK seem to flounder and bounce around, and it remains to be seen what kind of transitional arrangement or endgame we end up with, and what sort of economic impact that might have, and how it might interplay with the impacts of the pandemic. There's obviously the wider geopolitical concerns around US and China relations, particularly around trade, but also the big geopolitical concerns about security and so on. And the sort of central bank responses to what's been taking place. Obviously, we've seen a resurgence of quantitative easing and the impact of low interest rates and how they will affect economies, currencies, real asset prices, equity prices, and so on. The corporate response, or as a lot of you will have seen, has been to try and preserve cash and liquidity. That's either through a range of measures, including drawing down credit lines, furloughing staff, making staff redundancies and cuts, and also raising new capital. And in the equity markets, we've seen a very, very significant amount of equity raising, which I'll come and talk about in a minute, which has been a key feature of the impact of the pandemic most recently. In addition, as corporates have sought to raise cash and take advantage of state support mechanisms, there's been also a theme of burden sharing, and by that I mean companies and the other stakeholders having to share the pain of the impact of the pandemic. So most obviously, if you are taking, you say, state support, companies have been looking to share the pain through cutting dividends. Come on to talk about that as well. And also for executive to be taking remuneration cuts in the form of either salary decreases and or bonus sacrifices. That again is a very, very significant feature of the UK corporate landscape at the moment, particularly in the listed world, where these things are often played out in public. And the other feature we're expecting to see is a resurgence of M&A activity. So in the immediate onset of the pandemic, corporates and private equity houses were mostly focused on their existing challenges in their own businesses or in their own portfolios. And actually there was a very subdued level of activity in M&A through the first quarter and through the second quarter as the pandemic really took hold. But we expect to see a very strong surge in consolidation as the strong take out the weak, amidst top-line challenges, and also amongst quite depressed valuations that we see around the sector. And people who went into this crisis with perhaps the wrong kinds of and shape of balance sheet can't easily trade their way out of the problems. So those, I think, are a good summary of the themes that we're seeing. Obviously, there's the second, third order ramifications of the pandemic that we sort of can't go into detail here, but maybe explore some of those in Q&A. So moving on to the next slide, then we'll talk about the stock market and what were the key effects. So the UK stock market was actually saw the turn of the decade in fine form. Actually, the market had been rallying into the UK general election, and there was a sense of optimism that a decisive victory for the Conservative Party would at least herald some stability in the policy agenda and eliminates a lot of the uncertainties and division around some of the key topic areas, and promises of heavy infrastructure spending and resolution on Brexit, whatever your political persuasion, was seen by markets at least as a very positive outcome. And actually, UK equities were seeing inflows from domestic and international investors post the results of the election. But very quickly, obviously, we set into the pandemic through February and into March, and all that unraveled, and the stock market suffered some very, very heavy falls through the middle of March, troughing on around the 21st of March, at which point the FTSE All-Share was down 32% from the start of 2020 in just a matter of weeks. At the sectoral level, again, we've mentioned that stocks focused and companies focused on discretionary consumer and spending and cyclical industrials suffered the most. Also, companies with weaker balance sheets were also fell heavy victims to the sell down in the market. But as we said already, the government stepped in with some very, very heavy policy responses in terms of reflating the economy, supporting employment, supporting the SME sector through state loan facilities, and the experience of flattening the infection curve through the lockdown was very supportive to a recovery in equity markets, and they have managed to recover about 20% since that trough. But that still leaves the equity market about 18% off the level seen at the start of the year. So still firmly in bear market territory. And in that recovery, again, we've seen a number of perhaps a wider dispersion of performance across the different sectors. Some sectors actually have not managed to recover at all and have actually traded even worse. And I point to the UK banks in particular, who have very, very broad credit exposure to the economy, who are probably going to feel a significant amount of pain through their impairments. But also they're exposed to the interest rate curve. And as I mentioned before, the quantitative easing expected and actually taking place from the Bank of England and the Federal Reserve is having the effect of flattening the interest curve at very low levels still. So we're going to be in a much lower for much longer cycle than we had been already. So that is a very negative effect for the bank sector from an equity market perspective, if not a credit perspective. So that wraps up what's happened to the stock market and how it's recovered post-pandemic onset. I mentioned a key response by UK corporates has been to raise their liquidity levels through either drawing down on credit lines, preserving cash through saving on non-discretionary expenditures, and even cutting into the meat and the bone through significant employment reductions as well. But they've also raised a lot of capital. And on the next slide, you can see in the top right corner the chart which shows fortnightly capital raises since the middle of March, which was the onset of lockdown and the real peak of the pandemic. You can see that over that period of time, about 15.5 billion of equity have been raised by UK corporates on the stock market itself. Obviously, more would have been raised privately through private equity companies and founder owners having to inject more capital. Certain rules were relaxed around the ability to raise capital quickly, particularly around the UK's treasured preemption rights. And that allowed a very, very significant wave of recapitalizations in March and April. Then larger capital increases started to come through in May and June as the larger increases that require prospectuses were being completed and came through, and you can see the bulge in the sort of middle of May of over 5 billion being raised by corporates at that point. Happily, investors were sitting on reasonably large cash balances going into this crisis. I mentioned they were getting inflows post the election. Little they know they were going to have to use those balances to recapitalize companies rather than find new opportunities to deploy that money into. But as we went through the phase of recapitalizations and as the size of the issues became larger, some fatigue set in with regards to the amount of discount that investors were requiring to recapitalize companies. And you can see that in the bottom right chart of the slide. In summary, I would say that the UK investor base has stepped up to support UK PLC with fresh equity when it has needed it. And the feedback we get from investors is that you know, they see this as a combination of both opportunity, but also as a sort of to some degree a moral requirement to be seen to be doing the right thing for the UK economy as well. Moving on to the next slide, this looks at the point I made earlier about burden sharing, and you can see both graphs show the amount of burden sharing that's been split between either dividend cancellations and also significant cuts to executive pay and bonuses. In the main, if a company has taken support from the state or has cancelled a dividend, so thereby, you know, sort of either costing taxpayers or costing shareholders, the pain has to be shared. So the government has been asking companies directly, in the case of the banking sector, to not pay dividends, and other companies who've taken state support have felt a moral obligation to suspend or cancel dividends to shareholders while they're benefiting from that support. By the same token, executives are also being asked to share the blame, particularly if they are having to furlough staff, make staff redundant, and we've seen a very significant number of companies announcing some level of cut in remuneration for its executives. In the UK listed market, that's 400 altogether across the main market and AIM, and we've also seen a 25 billion dividend cut or suspension across the sector, which represents quite a significant loss of income to quite a number of pension funds and retail shareholders that rely on the UK equity market to supply those dividends. So finally, the other thing I wanted to talk about is M&A activity. You know, as you can see on the following page, the final two bars of the histogram on the top there, Q1 2020 and Q2 2020, relatively small levels of M&A activity, and a very large reduction in the average transaction value as well. So very, very subdued level of activity. But as I said, we expect that to turn into a surge over the near to medium term, based on a number of factors. First of all, with overall GDP growth slowing and even in many sectors reversing, companies are going to be challenged at the revenue and top line level, and will look to find ways to maintain margins through cost savings, and obviously a key lever is consolidation. A lot of companies out there will be suffering with weak balance sheets, and fewer strategic options other than to find other companies or private equity to sell to. Private equity, notwithstanding the fact that they'll have had to recapitalize a lot of their portfolio companies, were sitting on very significant cash balances as well. They've got a lot of dry powder, and they will be scouring the market, listed and unlisted, for opportunities to deploy that capital. And then there will be other dynamics at play, such as the need to accelerate the digital transformation. I think we've all seen through the pandemic how relatively easy it's been to operate in a remote fashion through digital technologies, through remote communications, working from home, increasing the shape of our digital spending relative to our offline spending, and so on and so on. And companies will be forced to accelerate these digital programs, and that will require buying in technology as much as generating technology on a homegrown basis. So we expect to see that as a key feature of perhaps the rest of this year. Obviously, Brexit is going to cause some uncertainties as we head into the end of the transition phase, but I think the UK PLC offers significant value, not least because sterling, as some of you will have noticed, has started to weaken again after a period of appreciation around the election, as the fiscal loosening and the monetary easing has bitten hard. So to international investors as well, UK denominated assets will start to look very cheap again. So I'll leave it there. Hopefully that hasn't been too complicated, but also sets out a lot of the themes that we're seeing from our perspective as a focused investment bank on the UK small and mid-market growth segment.
Andrew, it's clear that there's been a lot of volatility recently in the markets, driven by this weaker economic outlook, an acceleration of consumer trends, and increasingly financial robustness being brought into sharp relief.
Yeah.
Looking ahead, how do you think those changes will impact upon investor appetite? Do you think we've seen the end of recapitalization, maybe defensive type capital raises and defensive strategies? And do you think we're starting now, or your clients starting to look at, as you mentioned, offensive strategies, looking for targets to either drive growth or to increase their own sort of financial stability from perhaps like you say, diversification or strengthening, like you say, of their sort of revenue?
Yeah.
Equities?
Yeah, interesting question. So, as I mentioned before, the capital raises that we saw initially were largely either precautionary measures, the expectation that balance sheets were going to be damaged, and therefore, or liquidity was going to become a lot scarcer. So companies were raising money to bolster their liquidity in anticipation of problems. Some of those problems may be worse than anticipated and may trigger another wave of capitalizations. In some sectors may not be quite as bad as feared, and companies might find themselves with excess liquidity. They may choose to return that either through the resumption of dividends or specials, okay, or share buybacks. Or they may find themselves in a better position to take some other strategic options, be that M&A or sort of more organic investment. I mentioned that the preemption guidelines were relaxed. That allowed companies to take advantage of those relaxation in the rules to raise higher levels of capital. But those relaxations were only pandemic related, so you couldn't easily step over the guidelines to raise money for M&A or whatever. So that pandemic relaxation may come to an end, but it will depend upon the shape of the economic recovery, because if we find ourselves coming out of this this pandemic in a very sort of strong V-shaped type recovery, you might find that those relaxations are shut off and we go back to a more normal state as far as equity raising is concerned. However, if we find ourselves struggling, or some sectors struggling to come out of the economy and needing extra capital, I'm sure the investor guidelines around preemption will remain relaxed. And there's always the route to go down in terms of documented preemptive raises, such as rights issues and placing an larger placing and open offers. With regards to more offensive style raises, definitely we think that private equity have plenty of private capital, but they also continue to raise new funds. On the equity market, we actually see a sort of reversal of the trend of de-equitization that's been taking place over many years. I think this re-equitization of the UK equity market has triggered a realization that the capital is there, that the shareholders are there, and investors are there to support corporate need. And if that need is to take strategic action, to consolidate, to provide value accretive M&A, then I'm sure that the market will be there for those opportunities. And actually, at Peel Hunt, we're starting to see a lot of more front foot type activity amongst our client base in terms of thinking about M&A targets and the financing required to fulfill those ambitions. And we're seeing a build in our pipeline of equity raises stapled to M&A activity.
And you touched on valuations. I guess, how do you see those valuations sort of moving over, like I say, the year ahead, and how do you think stakeholders will evaluate those valuations, maybe perhaps in terms of financial robustness of the target entities, and sort of stress tests in that sense to withstand maybe second wave or something similar to that? But equally, I'm sure business model, and how that business model may be flexible or more adaptable as we learn from what's happened before, and again look forward with those perhaps acceleration of consumer trends that we were already seeing, but are really coming through now as a result of the situation we've been in.
Yeah, interesting question again. So it sort of goes without saying that one of the key features of the pandemic has been the loss of visibility on the future, in terms of how consumers and SMEs will react, what that will do to the demand picture, and how that will translate into revenue and turnover generating capacity of firms, and then how that turnover and revenue falls through into the bottom line, and valuations that are reliant on earnings metrics have obviously become a lot more difficult to measure because of that loss of visibility in the near to medium term. So the fallback has been to rely on more balance sheet driven measures such as book value and net assets, and to take perhaps a more strategic view that you've got a good business with a bad balance sheet, where with some financial engineering, with better capital structure, actually you can pick up a good asset that just needs a better way of financing. And I think there's going to be a lot of that type of work. So in maybe in the private world, there's going to be a lot of restructuring. So I think accountants and restructuring advisors are going to be very busy helping corporates recapitalize and restructure their balance sheets. We're going to see that in the listed world for sure. So in terms of the valuations, there's been a big loss of visibility. Actually, the UK equity market is trading on a very high PE of about 16 times. It's nearly an all-time high in the last 10 years or so, and the sort of level that was seen, immediately post the global financial crisis. And that's really a factor of the investor base market looking through the immediate drop in the earnings and looking at the recovery and pricing for that recovery rather than the immediate earnings base, which is sort of cyclically depressed.
Very interesting. And Andrew, how do you think this new reality will impact you and your business? Do you think you'll see any sort of fundamental changes in the way investors operate, the way perhaps that you conduct your business, more remote working, less sort of face-to-face road shows? How do you think the capital markets process almost in itself will change and adapt to this new reality?
Yeah, no, again, fascinating topic. I mean, I think investment banking is a highly traditional industry in some respects, but particularly in its working practices. I mean, everybody being in the same office, pulling long shifts, lots of sort of collaboration in meetings, in meeting rooms, and so on. Never felt to me that the industry would easily shift away from that type of work pattern. So being forced to do so, I think, has opened our eyes as well as the market's eyes to the potential efficiencies to be gained, and the realization that there isn't a huge loss of efficiency for sort of working from home or working in a remote way. So, for example, we at Peel Hunt were all out of the office by about the 16th of March, all 250 of us on laptops, adopting new remote networking technologies like almost everybody else. And obviously the biggest impact has been face-to-face chemistry in meetings and the ability to collaborate with people. We've just had to adapt to that. I think one of the most difficult thing is chasing down new opportunities, finding new companies, engaging with them. Whilst people have been generally more available because they've been at home and on the phone, that people have been sort of firefighting in their own backyards rather than necessarily wanting to devote time to new opportunities. Having said that, though, our activity, and I think for lots of our peers in the investment banking world, has been very, very high. Obviously, we talked about equity raising as a very, very significant amount of work for us. We expect that to shift into M&A as we've mentioned, but also we're very active on our secondary trading side. So retail participation in the recent pandemic was very, very high, and I think is very, very welcome. The process of working for corporates and interacting with the capital markets is changing and is going to remain fundamentally changed. So all the roadshows that we conduct for companies seeing their shareholders or raising capital have been remote roadshows. So it's all been either Zoom or WebEx or Microsoft Teams or or similar types of products. There have been efficiencies. Companies don't have to hop into a chauffeur-driven car and be driven around the city to and from the West End to Docklands and so on. So that actually saves some efficiencies. We can schedule meetings more effectively. Interestingly enough, some investors are saying that they don't necessarily need to. For companies that they're already invested in, they just need to have a call. They don't need to have a video facility. Actually helps some people because they like to be taking notes. They don't want to be seen to be taking notes. So a call suits better rather than video. But for new opportunities, so investor meeting a company for the first time, they want to see the faces, they want to see the whites of the eyes, the old cliche. So I think, things will normalize. There will be more physical interaction as we all sort of slowly go back to offices and clients start to come back into the city to meet us and meet investors. But I think there's a permanent shift taking place to more efficient remote ways of doing business.
Thank you, Andrew. Appreciate it. It's a fascinating time, like you say, right at this moment, and let's see what happens as we go ahead. But I'll hand back now over to Simon. Thanks very much, Andrew. Right.
Thank you very much, and I really appreciate you having me onto this webinar, and hope it's been.
That was really interesting with Andrew. I mean, what do you think investors are going to expect to see, regarding adjustments to businesses sort of post-COVID, thinking about, again, that new reality? I mean, if there's ever been a time where businesses need to be nimble, presumably now is it, right?
Yeah, Simon, I think it will come as no surprise if market sponsors, investors and boards were taking a close look at their business models. And I'm sure this will cover a number of key sort of governance areas, such as risk identification and mitigation, change and strategy, how your business will evolve to changing customer relationships and expectations, being prepared for a second wave or a similar fundamental event, such as surviving the storm is it's one thing, but if that empties the tank, it's how will you withstand and respond to further challenge and change, ensuring that you've got remote and flexible working practices embedded into your business, and that doesn't impact the customer experience or the operating integrity of the business, and whether that's at a digital and sort of cyber technology security perspective, or in a more traditional sense in terms of checks and balances, and also the availability of the right information at the right time to enable boards and management to make good decisions in times of stress, and with an eye to the sort of public markets, to be able to disclose price sensitive information in line with regulatory requirements. So I think absolutely the changing environment will drive and focus on business models and whether they're fit for purpose looking forwards into the future.
Yeah, I think for me, understanding the consumer trends and what the future consumer looks like, they may well be exactly the same person, but they'll expect different things from you, will be quite important. And actually, we're going to touch on that. I'll shamelessly plug our webinar for next week, but next week we are going to touch on a little bit more around customer trends and the consumer of the future. Kristen, just to bring you into the discussion, I mean, just picking really up on Andrew's comments regarding M&A activity having reduced. Let's bring it local for a moment. That was very much global and UK. What is the local experience and what are we seeing?
Well, I think, as Andrew mentioned, we have seen deals in the UK slow down, and the M&A tap was certainly turned off, and that did translate into a number of deals being put on hold locally that we were working on. That was certainly the initial reaction, whilst businesses or whilst business owners turned to their own businesses, looked at their own resilience, and waited to see how the target businesses that they were looking at performed. However, we have seen a number of deals continue on the island. We've got sectors that have proven to be reasonably resilient in sort of CSP, life assurance and segments of gaming. So we have still seen some transactions continue and M&A activity in some of our niches be quite positive, whilst, as I say, the more general picture has been for M&A to have been put on hold. So, and again, some of those deals that were put on hold originally that we did see slowing down here, even they are now coming back as well. So I think the picture actually locally is reasonably positive, despite the backdrop.
Yeah, and of those deals that we've seen, again, keeping new reality in mind, and I guess as a reminder, sort of new reality is your business model or operating model sort of fit for purpose for, say, the next decade. Are any of those investments sort of particularly strategic or diversification, or where you can see new reality strategies coming through, or are they just the same as before?
At the moment, here on the island, I'd certainly say we're seeing a continuation of what we would consider to be normal transactions.
Yeah.
To some extent, this is perhaps not a surprise. As I mentioned, people are looking at deals that they already had well progressed,
Yeah.
that are coming back now that they're comfortable with the resilience of the target businesses. Our UK colleagues are also starting to see transaction activity improve. I think, as Andrew referred to, there are opportunistic deals out there where there's an opportunity maybe to pick up a business that is seen as being weaker and can add to the top line or deliver a particular efficiency. And there's certainly significant cash behind the PE sector, which will be a key driver of activity, although the leverage PE model will rely on the debt markets and the debt funders and lending banks in particular. And I think that they will still be focused on the downsides and their own protection. To be fair, they don't tend to share in the upside. So I think the approach to diligence will still be fairly normal, perhaps more emphasis on the last 5 to 6 months, monthly KPIs, emerging trends. But it feels as though at this stage, we're still a little way off seeing those transactions that are transformational for businesses.
Yeah.
I don't think that has yet come through, and the true new reality that, in fairness, the PE houses are focused on, and were pre-COVID looking at adoption of digital technology, ways of accessing new markets and driving efficiencies. They're going to continue to be important, but accelerated. I think those businesses that can demonstrate that they've adopted new techniques or have taken acquisitions that have moved them in new directions, I think those businesses will see a real acceleration of value. And that will differentiate them from what we'll still see as a number of transactions that are more business as normal.
It's interesting, I spend it feels like every day, but it's probably every other day on global calls, plugging into the global network and what's being seen around the world. And it's interesting, in the sort of the G8 countries, it's fair to say many large businesses are on fast forward in that new reality, doing transformational deals and kicking off transformational projects, but we're not quite seeing it here yet. So hopefully that will start to come through. So let's turn a bit more to the practicalities around a process and hear from Ash. Well, I'm pleased to be joined by Ash Dougal, Group Director of Fundamentum Property Group, a group that we work with, but probably aren't that well known. And welcome, Ash, to your first KPMG webinar.
Thanks, Simon. Thanks, pleasure. Glad you had me.
Very welcome. So what I thought I'd do is, Ash, we've just heard from Peel Hunt around their views on capital markets. Obviously, we worked with you on a important for the Isle of Man capital markets transaction. I wonder if you can just give our listeners a bit of feel for that, and then we'll sort of just go through the real practical experience, because I think we've heard a lot of the theoretical stuff from Peel Hunt.
Yeah, so just a bit of background on Fundamentum. We've been a investment advisor to Luxembourg real estate funds historically. We sold, one of those funds was in the supported housing sector, and through that we sold a relatively large portfolio to one of the social housing REITs. Due to that experience, we felt that there was room in the market for more REITs in this supported housing sector. It was still fairly niche and untouched in many ways. So we decided to list our own REIT. Initially, we looked to list on the London Stock Exchange with Investec as the book runner and sponsor. Unfortunately, we had to pull the IPO during the fundraising period. It was just an unfortunate event, really, where between November 17 and June 18, no REITs were listed on the London Stock Exchange, and only one real estate fund actually listed successfully. Even Aviva pulled its IPO of a secure income REIT, citing lack of interest for investors. So it was just, the timing was bad more than anything. So we took a bit of time to reflect and still felt there's appetite in this sector to list another REIT. So we took the decision to try and list with the International Stock Exchange. We had a sort of pool of interested investors from the first initial raise that we on the London Stock Exchange, and they decided to essentially seed us for this listing. And Tizzy, we found, was much more flexible in the way that it's structured. We had to be a UK listed REIT, but at the same time, we didn't have to be FCA regulated. although we do have an AIFM that is FCA regulated, and we're appointed representative of that AIFM. So, you know, in essence, we are regulated, but the structure itself did not need to be FCA regulated, which made life a little bit easier. The other point being, there's not quite as much work and cost to list on Tizzy. So we just found the whole experience a little easier and cheaper, if I'm honest, in terms of the work that was needed to be undertaken to actually list.
Yeah, and obviously Tizzy is, you know, still relatively new to the Isle of Man. Obviously, well established in the Channel Islands. I mean, from advisors, obviously we worked with you on it. Was it easy enough to find the advisors around you?
Yeah, I think probably because we'd had that initial listing on the LSE and through Investec had been introduced to various service providers. However, with the Tizzy listing, you know, most of those providers really came from relationships we already had actually on Ireland. You know, myself with KPMG, you know, yourself and David Parsons, and then and some of my business partners with some of the other entities such as IQE and Keystone. So, you know, I think it was, well, for the island and the service providers around it, you know, we used everyone as local as we could, you know, possible. Langham Hall remained the AIFM, which are, you know, they also have offices in the Channel Islands, not in the Isle of Man yet, but that may change in time. So yeah, it was obviously a good experience and actually a much more, I suppose, convenient one, in that all the providers were on our doorstep more or less, and Tizzy was just down the road. So, you know, having meetings together was a fairly convenient and simple thing.
Yeah. Be interesting to see how many deals have been done recently locally, given the borders have been shut. But and you know, I mean, the just general experience. Obviously, it sounds like the Tizzy was a good experience from your side. My understanding was that yours was, it wasn't necessarily the listing of a already operating business. So it was a sort of the raise of a concept and an idea. I mean, how much of an issue was that for you?
Yes, I think obviously because we had that initial attempt on the London Stock Exchange. I mean, we actually conducted over 100 investor meetings for that.
Wow.
For that initial listing. You know, we were trying to raise a minimum of 75 million. So, you know, through those investor meetings, you know, we clearly had access to some decent sized institutional investors, which made finding a sort of seed investors a little easier because we'd already done the groundwork previously.
Yeah.
But at the same time, you know, we did have some credibility in the sector in that we'd obviously been an advisor to a Luxembourg CCAV SIF supported housing fund and had sold a pretty sizable portfolio to one of the REITs already. So that did give some credibility. And then the other thing is that we have, you know, we maintain a pipeline of these supported housing assets of between 20 to 40 million to deploy capital at any one time. So, you know, we knew that what we listed with, we would deploy in fairly short order. And by doing so, you obviously avoid cash drag and hopefully hit those early target dividends for investors.
Yeah. So clearly the team and their track record is important. You know, clearly being very, very clear in your strategy and what you're going to do with investors' money is key. I mean, how have you found sort of running a listed business? Has it been easier or harder than you expected?
Yeah, it's a good question. I mean, for me, actually, the listing process is the hardest bit. Actually getting the company listed, I think was certainly a bigger project than I'd initially imagined. More time consuming, stressful and expensive than I could ever have guessed, if I'm honest. But the reality of running on a day-to-day basis, I think providing, you know, you've got the right providers in place, you've got the right infrastructure and, you know, operational sort of measures, then you should be fine. You know, there is an added element for us with the FCA appointed representative through Langham Hall, which means obviously there's a fairly hefty compliance work that needs to be maintained ongoing. But I think that's a good thing, you know, in terms of it improves your reporting structures, which I think is necessary. So, you know, it's a fair amount of work, but it's definitely manageable, providing you've got the right, you know, staff infrastructure in place. Yeah,
and it's interesting, you know, we're talking to our clients. I think I think most would say the same. Actually, it's that initial listing period is really, really tough, and that's a very stressful moment for many of our clients. But actually, most people don't realise just how many meetings with investors you have to do, and and you roll out the same presentation nearly 100 times, and I'm sure you're an expert at it by the end, but you learn your tricks as you go along, and which things sit well with investors and which don't. But I mean, if there was anything you could have changed in the way you approached it, I mean, would you have changed anything?
Yeah, I would definitely. It would have been probably not to list on the London Stock Exchange, because we didn't actually need to. We just didn't have the experience really to appreciate that at a time. With listing on the LSE, one, you've got the cost and timing and amount of work of to do that, but also you need a fairly hefty IPO because of the cost, the OPEX to the fund or REIT when you're running it. You need a decent amount of money to launch with. So Tizzy provided a more flexible, more cost-effective way for us to do that. The other thing it's allowed us to do is we put a monthly placement program in place for 18 months, so we can actually raise on a monthly basis. Unlike the London Stock Exchange, whereby you'd have to raise, you have a C share class raise, a secondary raise of sorts. We've got a fairly flexible placing program, which is great.
Yeah. It sounds like you're an advocate of Tizzy.
I am. I'm a big fan. Well, actually, I was looking at some stats earlier, and I think now over 25% of UK REITs are now listed on Tizzy. So it gives you an idea that, and that's going to keep increasing, I think. So it's a genuine, alternative listing venue to London Stock Exchange.
Yeah, and investors understood Tizzy and sort of, in fact, actually, what was the investors' take on the Isle of Man, and they understood why you're in the Isle of Man?
Yeah, I think that can be quite it is an important point, and I think the key to this is that the REIT itself is a UK listed company. It's a UK registered company, listed through the International Stock Exchange, and through the AIFM, it is FCA regulated, in that respect. So I think that's important. The only reason, the advisor here is because we are genuinely based here. Our office is here and always has been. So, but I think that can be a question mark for some investors. So the fact it is a UK registered company is an important point, I think.
Yeah. And what's your recent experience been like, sort of throughout COVID?
Yeah, so I mean, the supporting housing sector has played a pretty important part, really, by assisting the NHS and providing step-down units. So it's reduced some of that, or at least some of the burden the NHS has had by providing, beds for them for adults requiring specialist care. And that, I don't think that's going to change anytime soon. So it is a really important sector, the supported housing sector. It falls under a category called exempt rent. So the funding stream is actually from central government, which local authorities claim from central government, and housing associations claim via local authorities, which is essentially part of housing benefit. So it's a pretty secure income stream as well. So, it's, as an asset class, it's, I suppose, become more institutionalized, really. It's, you get some, if you look at UK gilts, I was looking at recently, 10-year gilts, there's HSBC are projecting going to, 0%. So if you're looking at this is a pretty secure income stream that's claimed directly from central government, and you can yield 5+%, then it's worth looking at. Plus, you've got capital uplift on the asset that you're buying as well. 20-year inflation-linked leases, it's a pretty solid asset class. And the fact that you're looking after tenants with specialist care, there's a real ESG element to it. And if we can help the NHS, then that's fantastic during what's a crisis which we don't know how long this could last for. So it plays an important part, I think, the supported housing sector.
Yeah, it's interesting. I mean, certainly a number of our clients, whether they're on the investor side or they're involved in the sort of the health and care sector, there's definitely a lot of interest in this sector as an asset class, which I'm sure will be very positive for you going forward. I think there's a realization that it's almost, I don't want to jinx it, but recession proof as well. Realistically, we're all going to need care no matter what the stock markets and the economy is doing. So yeah, I can see it being quite a prominent asset class moving forward, absolutely. And certainly, like you say, the ESG, and we touched on ESG in last week's webinar, is definitely playing on investors' minds more as well.
Yeah, and as it should, it's a really important point there for us. We've just implemented an ESG policy statement, and what we don't want to be is one of those companies that just wants to tick a box. So we've actually designed some pretty hefty sort of questionnaire and templates that the housing associations have to fill out on a quarterly basis. measure all those, those various factors, the environment,
Yeah.
social impact, and corporate governance. So that is something that's the forefront of our minds, and definitely what institutional investors will be looking for, what are looking for now, and definitely will be more so going forward.
Yeah, great. Any other words of advice on the listing? Anything else you'd sort of...
Yeah, I would say be very prepared. Ensure you've selected reputable, efficient service providers, to manage it with you. But at the same time, expect delays on listing. Ensure you've costed the project accurately, because they can get out of hand. One bit of advice I would definitely say is, if you're any legal firms you're using, get them to cap their quotes, because they can get out of hand otherwise.
Right. And we've asked external guests this question throughout the webinar series. So KPMG's been talking its 4 R's, and the fourth, which isn't quite an R, but is the new reality. What does new reality mean for you, and what do you think, either at a personal level or for your sector?
Well, I mean, for the sector, because of the income stream, because of the tenants that require specialised care, and because of the burden on the NHS, I think it's only become more and more important in the role that it plays the supported housing sector, and get bigger and bigger and bigger. So we're glad to be part of it, and I think it's something that will certainly play a vital role with COVID-19 and any future outbreaks, in terms of assisting various government departments. So on that front, I think it's it's a very important sector to be in. On a more personal level, with us in the office, we'll obviously follow government guidelines in terms of that, but we've definitely learned that we can work from home. We did it for a few months, and there were no issues. And I think, to be frank, we've realised we can be a little bit more flexible with the way staff work, and cope absolutely fine, providing you'll communicate. You've got the right communication tools to do so.
Yeah, fantastic. Well, Ash, thank you very much for joining us and giving us the time. Really, really appreciate it. And speak to you soon. All right.
Yep. Thanks, Simon.
I mean, Christian, we heard there from Ash. Any sort of final thoughts from you and his experience, what you see?
Well, I think, just based on what we've heard from Ash and from Andrew, I'd just say, the local M&A market certainly is still active, and there are transactions that can and will be done, as some of our key sectors have proved so resilient. I think a private transaction is much less onerous than an IPO, as discussed by Ash there. And certainly we would expect then that vendors still need to be prepared to demonstrate their recent resilience, and they need to do that clearly, as there's the trend, particularly the trends in new business performance and cash generation in particular, bearing in mind the approach of potentially lending banks, etc. So yes, very much open market, not as onerous as these processes we've talked about, but still a need to be prepared, I would say.
Great. So let's turn to the poll, and thank you very much for your votes throughout the webinar. Really interesting to see 56% of listeners, I guess therefore businesses on the island, believe they're already in their new reality, operating in their new form, which is very, very positive. I must say that's now started to diverge from some of the other G8, and probably a little bit more positive than I've seen elsewhere, but great to see, and we'll continue to track that through the next few weeks. Once again, thank you very much for joining us. For those that want it, it's on demand on our kpmg.co.im webinars webpage. And if you do have any questions or want to follow up with the team about anything, please do feel free to reach out to me or to any of the team, and we'll get you answers directly. But next week, we'll be looking at the new consumer and how they're reacting to the new reality. And we look forward to for you to join us next week. Bye now.